We all know that we need to save for retirement. In fact, we're bombarded, it seems, with reminders about how we need to set money aside for our future selves. But how much money do we really need to be comfortable in retirement? How do we budget from our paycheck the amount of money we need each month so that we can reach that goal? What effect does taxes, fees, and inflation have on our future retirement? And are there other assets, vehicles, or things that we can do to increase our chances of success once we get there? My name is Jason Kennedy. I'm a retirement planner with the Kennedy Financial Group. And through this series, I'm going to answer each one of those questions. Now, the first question we'll answer is this one. How much do I need for retirement? Well, obviously, the answer is going to depend on your circumstance. Each person is different. But there is a formula that we can use to arrive at a personal number for ourselves so that we can know this is the amount of money that I need to save. Right? So here's the formula. Step one, we need to calculate our expenses. Yes, we need to determine how much money we actually need for retirement. How much will we spend on housing? How much will we spend on food and clothing? How much will we spend on health care? See, if we can calculate a rough estimate of these numbers and then add on top of that any additional income we desire to have for travel, for the grandkids, or for other things, then it'll give us a nice indication of how much income we need to have once we get to retirement. Now, the second step to figure out this number is to identify our income sources. Where will income come from when we enter retirement? Will we have a pension? What about Social Security? Will we have business income or rental income, or will we work part-time? I know that's not popular, but some people are choosing to work part-time to supplement their income, right? So we got to ask ourselves these questions. Do we know how much these income sources will generate? I'm going to put some links in the descriptions below to the Social Security website, as well as for Chicago teachers, I'll put in a link where you can access a pension calculator that'll give you a rough idea of how much your pension will be. But the point is that we need to figure out these income sources so we can compare them with our desired income in retirement. Now, once we put those two together and we take step three, which is subtract my income needs from my income sources, then we get an idea of how much we need to save. So, for example, if I've calculated my expenses and I know I need $60,000 worth of income, now you might need more or you might need less. This is just an example for easy math. Each person will be different. But let's just say I need $60,000 worth of income. That's step one. Step two, let's say I know that Social Security is going to pay me $20,000. Right? Now, Social Security will likely be here, even if it's different, but we're going to estimate that it's going to pay $20,000. So if I have $60,000, Social Security is going to pay me $20,000. The difference between those two determines how much money I need my savings to generate. That difference is $40,000. So I need to save up enough money where I can generate $40,000 in retirement to make up the rest of my income needs. Now, the last thing we need to do is to figure out what that equates to in actual money in an account. Is we take that desired income goal and we multiply it times 25. That gives us the amount of money we need to save. So in this example, if I need $40,000 worth of income, then I multiply that times 25. That'll give me $1 million. That's the amount of money that I need to save if I want to be able to pull out of my retirement account $40,000 every year. Now, you might be thinking, why are we multiplying this times 25, right? If I have $1 million, surely I can pull out more than just $40,000 a year. Well, the reason we do this calculation is based on a rule called the 4% rule. Now, this was a rule that was based on a retirement study where they looked through history and they tried to identify the best way to pull money out of your retirement account without running out of money. And as they ran through these mathematical calculations, they were able to walk away with the fact that if you want your money to last for 30 years in retirement, then you can't take out more than 4%. That's why we multiply it times 25. That's a backwards version of withdrawing 4%. All right. Now, some people might say you can take out a little bit more. Some people might say you can take out a little bit less, but you're not going to get too far away from this 4% rule. And that's why we say take your desired income, multiply it times 25. That'll give you the dollar amount you need to save for retirement. Now, as a side note, there are other strategies that can help you build up retirement income. For example, some people look to cash value life insurance, which is a life insurance account, so that they can supplement or add to their retirement income. Now, I know what you're probably thinking. Why in the world would I think about life insurance when it comes to saving for retirement? That makes absolutely no sense. And true, for some people, it doesn't make any sense at all for them to think about this strategy. But in other cases, it might. There are reasons why some people look toward life insurance. It's tax-free. Well, that's another benefit. We'll get to that in another video. Okay, this is going to be a series that we're going to keep doing. But for now, no matter how you choose to invest or save your money, if you run through this calculation, if you figure out how much money you need, what your income sources are going to be, subtract the difference, take whatever that difference is and multiply it times 25, you're going to have an income goal. And that's going to give you clarity and focus as to what you need to do for retirement. No matter how you feel about this, running through this calculation is going to allow you to determine, can I retire early or do I need to work a little later? Do I need to save more money, increase my rate of return, or readjust my expectations for retirement? And so this is the essential first step that a person really should take when it comes to retirement planning.